Good morning and welcome to the Daily Hunt for Multibaggers on this Monday, February 23rd, 2026. We've got a fresh batch of insights for you from yesterday's market chatter.
That's right, Ethan. Our analysis of social media discussions revealed a moderate amount of activity, flagging a few key stocks. The overall market sentiment today is, well, quite mixed, showing both some intriguing growth potential and some noticeable risk factors for us to dig into.
Let's kick things off with Netflix, symbol NFLX. This one's definitely got people talking, jumping up to 16 posts yesterday after a quiet couple of days. The big news, of course, is the DOJ probe into its potential acquisition of Warner Bros. But here's the twist, Brooke. Many users are actually suggesting this probe could be a good thing for Netflix shareholders. They believe the market might prefer the merger to fall through, potentially saving Netflix from overpaying, leading to a breakup fee, or even opening the door for share buybacks. Plus, we're seeing strong insider buying, over 750,000 shares purchased in the last 6 months, showing real internal confidence. And, with the stock trading near its 52-week low, this could be a real long-term growth opportunity, especially if the perceived negative news ends up being a net positive. It was even a buy for us back in late January.
Well, Ethan, that's certainly one optimistic take on a regulatory investigation. But we need to look at the hard numbers and the immediate risk. A DOJ probe, regardless of user sentiment, introduces significant uncertainty and potential delays or even a blocking of the deal. Netflix's price-to-earnings ratio at around 31 is still relatively high. That PE suggests investors are still banking on strong future growth, and any prolonged uncertainty or integration risks from a merger or even a failed merger with negative fallout could put pressure on that multiple. While it's near its 52-week low, that also reflects current market apprehension, not just a clear buy-the-dip signal. Let's not forget, our previous ratings for NFLX have been quite volatile, often landing in the stay-away category, even as recently as February 13th. For short-term speculators, the risk here is considerable.
I agree it's complex, Brooke, but the fact that the market itself might view the failure of the merger as a positive catalyst is unusual and compelling. It removes a potential overhang, potentially leading to improved sentiment and a rebound from that low price point.
That's a big if, Ethan. The market doesn't always react as users predict, but for those willing to tolerate that risk and look long-term?
Right. So for Netflix, symbol NFLX, considering the strong insider confidence and the unusual potential positive spin on the merger outcome, we're classifying this as a cautious buy for long-term investors willing to tolerate the current regulatory uncertainty. All right, next up, we're talking about NVDA, symbol NVDA. This is the AI darling, and it's grabbing a lot of attention, with 45 new posts yesterday, a big chunk. This company has been the driving force behind the AI revolution, boasting an incredible 62.5% revenue growth. They're expanding partnerships with Meta, making strategic investments. It's clear they're still at the forefront of innovation.
Ethan, while the past performance and innovation are undeniable, we need to talk about the current valuation. NVDA's price-to-earnings ratio is nearly 47. That is an exceptionally high multiple, implying expectations for truly explosive continued growth. However, our analysis suggests that the explosive phase is over, and future returns, while perhaps still good, will be more modest. And a KPI that really raises a red flag for me is the insider trading data. We've seen nearly 1.9 million net shares sold by insiders over the last 6 months. That suggests those closest to the company might believe the stock is fully valued, or that the most significant growth period is in the past.
But surely the demand for AI infrastructure isn't going anywhere, Brooke. NVIDIA is still crucial.
Crucial, yes, but the investment landscape for AI infrastructure is diversifying. The sentiment from our data warns that focusing solely on NVDA might mean you're in the segment where momentum is fading, with other areas potentially offering better growth. And let's not forget the crucial earnings report coming up on February 25th. With such a high PE, any slight disappointment could lead to a significant correction. Our previous ratings have often leaned stay away or speculative gamble for NVDA recently, precisely due to these valuation concerns.
It's a tough one, Brooke, because the growth story has been so strong.
It has been, but past performance, as they say, is not indicative of future results, especially when the indicators suggest a shift. So, for NVIDIA, symbol NVDA, given the extremely high valuation, the insider selling, and the analysis suggesting a slowdown in its explosive growth phase, we're classifying this as a stay away for now. The risk of a downside correction appears too high at these levels.
So for today's Market Watch, Brooke, let's round up our final candidates. Investigate as buy, none. Investigate as cautious buy, Netflix Inc., NFLX. Investigate as speculative gamble, NVIDIA Corporation, NVDA.
And that brings us to the end of today's analysis.
This podcast is for informational and entertainment purposes only. The content is generated by artificial intelligence and does not constitute financial advice. Listeners should conduct their own research or consult a licensed financial advisor before making investment decisions. We are not responsible for any losses incurred. The market is a wild place, and knowledge is your best asset.
Thanks for tuning in to the Daily Hunt for Multibaggers.
We'll catch you tomorrow.